Are we in the midst of a boom or a bubble? Hi, everyone. Welcome to the Market House. I'm Maggie Lake, and today I'm talking markets with Vincent Deluard, Director of Global Macro Strategy at StoneX. Hi, Vincent. How are you?
I'm great. Hi, Maggie. How are you?
I'm doing great. We already, before you all joined us, we were chit-chatting before the show, and we've covered everything from earthquakes to aliens. So I think this is going to be a good one. We're excited about this. Hey to everyone who's joining us live on Substack and YouTube. It's great to see you. Really interesting start to the week here, Vincent. It was kind of a weird mix of headlines, I thought, but clearly the one that stock investors were paying attention to was news that Nvidia said it would invest $100 billion. That's billion dollars into OpenAI for the build out of data centers. That was enough to help the S&P and NASDAQ get to a new high. So I guess we should start there. How are you thinking about this whole AI trend?
I mean, you started by, saying bubble or boom. I would say both, that's at the end of the day, I think that's where we are. I mean, there are elements of it that are certainly look very bubbly. And then there is an undeniable economic impact. I mean, you see CapEx just on the hyperscaler add 50 basis point of growth this year. So the question is, how long can that be sustained? Because the thing with CapEx is at some point you gotta, you're kind of stealing from the future, right? Because your CapEx doesn't come out of your earnings. It will come out very slowly as assets get depreciated. And you also have questions about, I think for AI, especially the depreciation period is very important. If we have a faster depreciation cycle, that means that earnings are overstated. But for now, yeah, money's flowing and the growth is booming, and yeah, stocks are made a new all-time high again.
Yeah, it's certainly hard to fight it. DD saying melt up only in the fifth inning. Well, we'll see about that. But do you? I mean, there was this. Especially from you, interested to get your sense. There was a thought back in April that the U.S. was looking so overvalued, and that the opportunity was in the rest of the world. And we've only seen stocks go straight up from April. Do we have to rethink that, or is this just a sort of an overextension of something that's bound to reverse?
Yeah, I remain in the camp that the most interesting opportunities are probably abroad, and I think here, we see the Max 7, we see the market, but if you look at other assets, they've done even better. I mean, look at a chart of Alibaba, look at a chart of, Spanish banks, look at a chart of even the Brazilian stock index. So despite this fantastic rally, especially if you take into account currency, I mean, US stocks have underperformed. So what this reminds me of to some extent is kind of the, 2002, 2007 period, where with somewhat of a similar setup where, Fed policy was extraordinarily accommodative. We had these big twin deficits. And yeah, US stocks were going up, but the rest of the world was going faster. And I think that's more where we are. As far as this great rotation idea, it hasn't even started. I mean, that's the, people thought in April, foreigners are selling. No, at best, what foreigners were doing, they were hedging the dollar, which kind of explains, Max 7 up, dollar down. Is, there is, China, you got a little bit, but some for political reasons, kind of hard to allocate a lot of your portfolio in China if you're like a Dutch pension fund. So people, I think, have kept the Max 7, even added to them. I mean, if you look at the latest Z1, the Fed's flow of funds, you see that foreigners were net buyers of stocks in Q2, which included that massive underperformance, big dollar sell-off. So I think people are still buying. Foreigners are still buying. But I do think that over time, as we get to this era of what Russell Napier called national capitalism, the idea that we will renationalize our savings because we have these demographic issues around the world, because we also have a much more aggressive U.S. administration, the U.S. will become a source of funds instead of being the recipient. Basically the marginal dollar in global savings found its way in the Max 7 stocks for much of the past 5 years. I think that's going to reverse, and that's going to take a very long time. As we do that, that puts pressure on the dollar, that boosts growth overseas, and that will accentuate the trend that we are seeing now of international outperformance.
It's interesting when you describe that, because I feel like you sort of paint it as a long-term trend that takes a while to turn. But I feel like so much of the commentary is everyone looking for some massive correction. There's
Right.
gotta be, if the US is overvalued, or if you're worried about that, and I think a lot of people are, then all of a sudden the bottom's gonna drop out, right? Everyone will head for the exits at the same time. Something that feels like that.
Well, I mean, I'm partly guilty of that. So I had a very good start of the year, called the bear market in March. Then in April, this piece that worked, the beginning worked really well. This was spring rebound. The idea was that, stocks were oversold. Trump would taco out of it. Then by the summer, the rally would kind of lose steam, would kind of drift around, and then we'd get a correction by, early fall. And look, I mean, we're already end of September, and it still hasn't happened.
Mm.
It was a very popular view, I think, among strategists, the idea that we'd make marginal new all-time high, kind of a double top situation, and then we had all this almost perfect storm in the fall, with a squeeze on liquidity. We lifted the debt ceiling, so you had to refill the Treasury General account. That should have taken away about $800 billion in liquidity. Other small factor, positioning, seasonality, is usually weak. I think we are seeing a lot of people give up on that. I saw, I think, Goldman Sachs up their targets. Merrill did the same thing. And, I would wait until mid-October to do that. I still think, like, October, we have tax payments that are due, usually about $350 billion in taxes. We'll get a bit more because Southern California was impacted by fire, so they couldn't pay. We'll have the impact of the Doge buyouts finally expiring. So we'll have companies reporting earnings, so they won't be able to do buybacks. So I would wait. And I hate to do that, right? Because in general, I hate when strategists do, I expect some volatility in the medium term. So what I try to do is I try to, put a date to my forecast, which of course makes me look like an idiot. So initially I started with the idea of a summer correction. And now, well, maybe September is still kind of summer technically, right?
Mm.
And now I'm afraid I'm going to extend it to October. And it's very easy to say, well, you can keep, extend it until you get right. That's the beauty of writing research instead of managing money. But if it doesn't happen by October, I think I'll take the loss, because if we get a good earnings season, which probably we will, after October, we still have a lot of buybacks that can be deployed. Then we get into the Santa Claus rally, Thanksgiving, very positive seasonality, and then after that we'll get the kick in from the OBB. I think part of that idea of the slowdown was that the fiscal impulse would moderate before it kicks in again. So give it another month. I think there's nothing wrong with being in cash now. I mean, we had not massively in cash, but if you're in stocks, stay invested. But we had a massive year. I mean, I look at my own personal portfolios. I mean, I have like so many names that are up more than 100% this year, and I was like, is it me who's a genius, or is it just a bull market?
Yeah, I think a lot of us are wondering that, and we don't want to lose it, right? We're concerned about seeing that evaporate. Why do you think that? Because there are lots of things to look at, and you can tell me what else was on your radar, but there are lots of sort of warning signs out there that would lead you to believe that things are looking a little frothy and that we could pull back. We saw labor market. Some people are getting worried about the jobs market, and maybe it's a little weaker or much weaker under the hood than people think. We had Tricolor, that auto subprime lender. These things are kind of buried because there's so many headlines, but people looked at that and thought that's a little worrying if we're seeing that. You mentioned we have a potential government shutdown, looming again. And Washington is so divided that, in the political battle, do they push it over the edge and spook investors? There's a lot of things to be worried about. Why haven't we seen any kind of pullback? What's holding it up, or what's supporting this?
Right. So let me answer the two parts of the question. I mean, the first part was about the cracks that were kind of appearing, and the second part is why is it not working? The first part about the cracks, in general, I'm not too worried about the macro. Yeah, we had a couple bad job report. We had a big quarterly revision. Um, my view is that, to, it's not slowing as much as people think it is, because we still have kind of that fiscal gorilla, inflationary growth miracle. The tax collection indicator that I follow are growing by like 8% for the year, even 10% in summer. Now, some of that, I'm not claiming we are having like China level rates of growth, but we can get into as to why that's happening later, but it's still pretty good. And then, in prior big, '08, 2000 events, you saw it in the tax collector before, because before the economy turns, you cut overtime, you cut bonus payments. So I'm I was never too worried. I thought some of the, it's very difficult to estimate the job market. Our tools are broken. There was that big, scheme floods in Texas. If you look at the spike in claims last month, that was really all Texas. So to me, it was never the macro that rewarded me more. And it's interesting you brought in the tricolor story, because I think it ties in. It's the immigration story at the end of the day. Yes, there is some weakening, because we went from taking in 3 million migrants a year to having net negative immigration for the first time since, the founding father landed in Plymouth. So that slows the economy, but that doesn't really loosen the labor market, right? Because these are people who either they come back, or they stay hidden, but they don't really default on the house because you don't have a house. So it doesn't loosen the labor market in the same way that, when you have like mass layoffs like we had in Detroit in 2008. So for me, it was not the macro that was the biggest worry. The biggest worry was really these kind of technical liquidity factors, which is very hard to do. Like sometimes I feel like, my position is almost an oxymoron, right? If you're long if you're bullish on nominal growth and you think the Fed is too easy, just buy stocks at the end of the day. But that being said, like even in that environment, which I believe is generally correct, we have accommodative monetary policy, stimulative fiscal, and an economy that's fundamentally growing quite rapidly. You can still get kind of, but it's more like air pockets in a plane. Like it's a little accident because the market got overexcited, valuations are too high, liquidity tightens, positioning is too one-sided, and you get like a 10-15% correction. My idea was that we were gonna get one this summer or in the fall. Like I said, I'm still not giving up. I think one of the reasons why it hasn't happened, frankly, is because everybody was expecting it to happen. I mean, it's the usual curse, the Cassandra curse is, and now we are seeing I mentioned Goldman and some of the big banks are all kind of giving up on the story. They're like, okay, well, let me up my target because it's a bull market. I cannot afford to be out of it. Ultimately, I know it's a disappointing answer. It sounds like, more buyers than seller, but I would say it's positioning.
Yeah, well, I mean, that has been the case as we've seen. Doug asking, do you have a direction for the dollar DXY into year end? Thanks.
Yeah, generally lower. Again, I mean, we see, we're back in this kind of twin deficits era with the Fed. I'm surprised by how easily the Fed kind of gave up. I thought they'd put up more of a fight, but if the Fed is saying, hey, I'm okay with it, I'm going to overlook because we did have bad inflation. We had the things I kind of expected. I had a report called a September stagflationary storm, and my idea was that we'd see like harder than expected inflation and weaker than expected labor market. We got both things, but the Fed really chose to ignore the inflation data and focus on the labor market. So that tells me that the Fed is going to be easy at a time when the other central banks are either contemplating hikes. We're going to see hikes in Japan, or pauses, like the ECB is basically good where it's at. So on the margin, rate differentials are working against the US. We still have a very overvalued currency. And then we still have this overhang, I would argue, of excessive foreign investment in the US that somehow needs to come back. And then what I would stress about this dollar cycle is that they're self-reinforcing. Because, we no longer, the way I like to think about it is back when we were under the gold standard, you look at the 19th century history is basically just a long depression, right? But a good kind of depression, like prices are falling because gold standard is inherently deflationary. And then whenever they would find gold in Alaska, South Africa, Australia, they had these huge burst of activity where everything would go up. Now that we're under the dollar standards, the finding gold is a weak dollar. Like a weak dollar has the same effect on global growth as finding a major gold deposit in South Africa. It just means that it's easier for everybody. Emerging markets, you get a lot of debt that's held in dollars. So if you have the dollar index down by 15% on the year, which is the case, then suddenly everybody's liabilities are much smaller. Central bank has room to ease. That boosts domestic consumption. Growth picks up. Real rates and then it just keeps feeding on itself. So that's why these currency cycles are very long. Like, I mean, if you look at this current dollar cycle, it started in 2011. So it lasted for, almost 15 years. So yeah, I think it's just the beginning. The inning part, I'm not sure how it applies to stock market, but I'm more confident about the currency market.
So if we have that weaker dollar being beneficial to emerging markets, you definitely like some rather than others, or do you think everyone benefits?
Well, there is a rising tide element of it, but I think it lifts all boats, but not at the same pace necessarily. I mean, let's just look at who's winning. I mean, so far it's China. I mean, silent bull market, but now for 2 years, I mean, tremendous volatility. But pretty much since we had that big deficit announcement, I mean, Chinese stock market has really many names look at Alibaba. I mean, they've more than doubled, and I think it's yeah, it makes sense. I mean, you had a long deleveraging cycle, real estate bust starting 2018. So if you were to take I know it's not apple to apple, but not 2018 in China was what 2008 was in the US, and now we're kind of getting like 2012, 2013 in the US, which is when the bull market became led by the big tech names, as we are seeing in China. I mean, we've seen this massive surge in industrial loans that led to violent competition, where pretty much every province, every town wanted its EV manufacturer and solar panel, and now champions have emerged. I think this is a time when margins start to expand, and where stock market investors reap the benefit of the massive investments that were made over the past 5 years. So that would be one place. People are probably tired of hearing me mention Brazil, so I'll just say quickly, Brazil, we still have this Selic rate at 15%, 1.5, inflation's 5%, 10% real rate. My idea is that it's going to come down. As it comes down, suddenly equities become investable again. I mean, why would you ever buy stocks when you can get 1% a month in bonds, right? But looks like the tide is turning. If I'm right on China doing better, that's increased momentum for Brazil. Political winds that are probably shifting as well across LATAM, with political risk coming down. So yeah, I would overweight these two, and then on the other side of the basket, I would look at the big winners of the past 5 years and be like, yeah, maybe it's time for them to take a breather. India and Poland, to me, are the ones that really benefited from the prior era, benefited a lot from the Russia-Ukraine war. Poland, obviously, being at the more or less the front line, big military base, big build-up. All of Europe, had to basically give them money. They also benefited from huge influx of refugees, very often highly educated, came boosted consumption. So Polish stock market has done very, very well. Polish economy has done very well, more or less caught up with the West. And then for India, it's been mostly for the commodity purchase channel. As we put sanctions on Russia, Russia couldn't sell its oil, so it turned back to India. India was allowed to buy it in rupees, which is huge. Again, for most emerging markets, going back to this dollar question, I mean, the biggest problem is how do I find dollars, right? Certainly, if you can settle your commodity trade in your own currency, biggest constraint is lifted. You can do other things. Growth picked up. In some cases, they were just, importing and re-exporting, just kind of arbitraging the sanctions. I don't think this is going to last. India used to trade at a discount to the MSCI emerging markets. Now it's at a huge premium. So yeah, maybe it's time to kind of rotate. And then the last thing I would say is when it comes to AI, you have to, wonder who the winners are and who the losers are. And we see a lot of worries in the US about the impact on young graduates and youth unemployment rate picking up. If we really think that it's going to displace jobs, I think the first ones to be cut will be the subcontractors in India or the Philippines, the back office, customer service, all the things that during the Indian miracle was built upon. Is quite vulnerable to AI. On the other hand, I would think that China's focus on manufacturing, having excellent infrastructure, very reliable power, makes it a more attractive destination. Because if at the end of the day, AI means that the country with the cheapest energy and the best infrastructure wins, could be the trade of the decade is China over India.
Yeah. Of course, huge political implications there, but I've been thinking a lot too about that sort of back office support, aspect of India with AI. I think it's something that's really going to come into focus. We had a question, and I want to make sure I get it in. Let me ask about Argentina. General, I'll get your question of oil in 1 second, but while we're on emerging markets, let's just circle this. Interesting news again. So many headlines today, but Scott Bessent coming out pledging U.S. support to Argentina, sparking a huge rally in that country's bonds. How are you thinking about Argentina, especially now with this, endorsement from Bessent and what looks on the surface to be U.S. financial support?
It is. I mean, you sort of see it on the bonds were up like double digit today. I would kind of put it in the winners of yesterday basket. Great story, huge rally. I mean, both the currency, the bonds, the stock market. But yeah, Argentina is never as easy as you think it is. Yeah, the local elections, there seems to be a huge gap between the perception of Milei outside of Argentina, where he's become kind of almost a rock star, right? Everybody points to him as the hero. And I'm not underestimating what he's accomplished in terms of inflation, in terms of but he's much more popular abroad than he is at home. So there were local elections that his party lost badly. I think they're heading into midterms next year. And yeah, like things like U.S. support, it helps the government, but that doesn't buy you an election. So again, I think it's in general, with EM, it's the quote, you want to invest. It's easier to make money from horrible to bad or mediocre than it is good to excellent. And I would put kind of, to make more money in Argentina, you need at least things to stay good, and more likely, I kind of a believer in entropy at the end of the time. You go back, revert to the mean, right? And the mean for Argentina is unfortunately not very high.
Fascinating stuff. General Snussen is asking, is oil only a supply story? And then his next comment, with a booming economy, I find it strange that oil lags.
Me too. Yeah. I think as we see, you just had the IMF revise its growth forecast higher. We have generally stronger growth than expected, and oil is kind of missing out. I think in large part it's the U.S. production keeps, but I do think eventually it's going to roll over, and probably next year, and if and when it rolls over, then we'll realize that the market is probably tighter. But for now, it's it hasn't participated.
It hasn't. And General, you mentioned the booming economy. Let's circle back to the first headline we had out, which is this massive rush for data centers. Everything related to that AI story has energy connected to it, all kinds. So it's sort of interesting that there does seem to be a disconnect for that. Paolo Macro's in the chat. I'm sure you have some thoughts about that, Paolo, but and all you nat gas people as well. But you know, we just have an insatiable need for energy, and yet it hasn't been showing up in the energy sector. I know a lot of people are watching that. Coach Dale's been watching the charts on that too, so it's going to be an interesting one. The government shutdown, Vincent, the market tends to ignore these things because every time it's all this theatrics and, you know, back and forth, saber rattling, and everyone slamming each other in all the ways Washington's so horrible for, and then they push it through. Is there a chance that the market may be too complacent going into this, or is it just another one of these political stories that isn't real until it's real?
If it does happen, I think it's going to hurt more this time just because our growth is so dependent on fiscal. But I don't think it's going to happen because at the end of the day, shutdowns happen. Only the Republicans have the you can say the coronas or the ideological biases to do it. Typically, these things backfire against the party that is seen as the one causing it. So I'm not sure that would be great politics for the Democrats to engineer one. So I think it's gonna be a chicken out story. But yeah, if they don't chicken out and we do see a shutdown, I would argue that it would be economically meaningful.
We have PCE out this week. We were talking about Fed rate cuts. We've got, I think, the market expecting 2, maybe 3, but Stephen Mirren's talking, and he's going to continue, I'm sure, to be very vocal about where he thinks the Fed's neutral rate should be. Do you think that we're going to start? What do you think is going to happen with the inflation data?
I mean, PCE is not a huge deal because by then, you know, you have the PPI, CPI, so you kind of it's not going to surprise massively. I mean, at most, it's going to be like, you know, 10 basis points from the rounding. And let me see what the expectation is. Q over Q. Yeah, we have it at 2.5%.
But nothing scary enough for the market to rethink the trajectory that the Fed's on.
Not on PCE, but I remain of the view that, you know, it's more than, you know, the CPI later that I think is going to come in stronger. I still think we haven't seen the full effect of tariffs. We are in this you know, Schrodinger's cat moment when it comes to tariffs, where the money is coming in, like you see it in the day treasury statement. You see these, you know, 40 billion coming every month, and then supposedly, you know, it's not coming off of margin.
I don't know if it's just me, but I think Vincent froze on us. Oh wait,
Yeah,
I think
right.
he's coming back. Okay.
Right, so all these earthquakes. So yeah,
yes,
I was saying
for real, Vincent has been experiencing earthquakes in where he is in California today. He's right near the epicenter. So, oh my gosh, maybe that was an aftershock, Vincent.
Maybe. But yeah, going back to the tariffs, I think this question, so the Fed has taken this view that it's you know, one-time adjustment the price level. I mean, if you listen to Stephen Miran, he'll even explain to you with a straight face that tariffs are deflationary. I won't go as far. You know, my view is that it's more kind of a creep up, a creep higher as you run down inventory, as you transmit it through the supply chains. It's going to play out over a couple months, and then there's no guarantee that these tariffs stop. I mean, like, we've seen how Trump likes to negotiate. I mean, my idea is that, you know, he will get away. As long as he can get away with it, he will keep doing it. So there's absolutely no certainty, in the same way that, you know, he's the one who negotiated USMCA, like, you know, 6 years ago. And then, you know, he tears it apart and says, it's the worst deal ever. Let's do a new one. So we can go through his process. And again, I think that it's not just the tariffs. At the end of the day, it's kind of deglobalization story, right? I mean, it's what really helped inflation, and if you look at the chart of core goods over the past 20 years, it was constantly negative. That's what kept inflation on target, was having negative core goods, and that allowed us to have, you know, shelter at 3.5 and services at 3. Now shelter might fall a little bit, but, you know, core services is 3.5, 4. So you really need these core goods to stay very negative, and that's the part that I just don't believe is going to happen. So over time, we see this upward drift in inflation, and that makes me think that the market's expectation for Fed cuts right now, we have 100%. It's like, okay, they're gonna cut in October and in December for sure. I don't think it's sure. I don't think Powell thinks it's sure either.
But of course, we know that there's huge political opposition to that. So does the bond market follow the Trump administration, or does the bond market follow the inflation data? Like, where do you see yields going?
Still, at short term, it's increasingly becoming a political question, and you have to, try to play with like the little chess pieces on the board, and who's Team Trump and who's not, and what's going to happen to Lisa Cook, and will Powell stay on the board? Will they have a majority? There's a scenario where, they can, we can see a Trump Fed in a couple of months that will accommodate. My idea is that the data is going to be so bad by then that it's going to be very difficult to do, which is, I think, why we've seen such a intense firing on the Fed, is because the Trump administration understands that now is the window. Now, it's not great on inflation, but you can still make the case, okay, we are, high twos on PC, it's been falling. Like, okay, you can make that case. If we get like 3 or 4 months of re-accelerating inflation, it'll be obvious that you're doing it for political reasons. So now they still have, plausible deniability if it backfires.
That's so interesting. And I think is going to make this next couple months worth of data really, really important. Vincent, it's such a pleasure to catch up with you. People were worried about you with the blurry camera, that maybe you were cool as a cucumber as the earth shakes literally beneath you. But I think he feels like he's okay, people. I think Vincent does not feel, I would hope he would unplug and run away if he felt like he was in imminent danger. But we appreciate your coolness through it all, Vincent.
Pleasure. Always fun to be with you. I would not miss my Maggie Lake interviews, even for an earthquake.
Thank you so much, Vincent. Thanks to all of you for joining us and kicking off the week with us. We appreciate it. We will see you again next time. In the meantime, as always, take good care.